So first of all, let's talk about, what is the use case for bonds, right? The main concept of investing and investments is the idea of increasing wealth. So usually when we think about stocks or cryptocurrencies, we think about, in crazy gains and trying to make as much money as possible or invest your money to grow your portfolio. Now, bonds, of course, have the same concept, but they tend to have two extra, let's say, intents. One is the idea that you're trying to preserve wealth. So they're less risky, which is kind of the second point, is risk management. So they're less risky, they reduce your risk, and they're usually try to preserve your wealth. And by preserving, it means that if inflation is about let's say 2 to 4%, and or usually lower possibly, and you have a bond that returns you 2 to 4%, then you're preserving your wealth in the sense that you're not losing money because of inflation. Bonds returns are, normally speaking, fairly low, but we've seen recently with interest rate hikes much higher bond levels. So I guess the main point here is, compared to stocks, and let's start with that. While stocks can go all the way to zero, all the way to infinity, bonds are a little bit different. So the whole idea of a bond, you can think about it from a very, very high level. It's essentially somebody lending, you lending money to someone in exchange of a fixed rate of return. So let's imagine that Francesco gave me some money. I gave Francesco some money. He gave me a bond, and the bond said, I'm going to give you 2% interest on the money every year so I can run my business. So that's one type of bond, and the most common type of bond. And this can be issued by a company. Like Francesco could have a company, could be issuing his bond, or it can be issued by the treasury, the government. And treasury bonds or treasuries are a little bit more interesting right now because they usually tend to be the safest ones. So investing in a treasury bonds means that unless the whole government goes bust, and unless the country you're investing in defaults, maybe like it happened in Greece a few years back, then theoretically your risk is reduced or nearly minimal, nearly zero. So let's say the United States, unless the United States defaults on their own debt, then it's incredibly unlikely you will lose money by buying a bond. So you can see why 6%, 9% bonds are extremely appealing right now, because essentially means you're guaranteeing yourself 9% every year, unless the United States defaults on their own debt. So that's kind of like the whole use case, right? That's use case for the government. They basically raising money for government expenses or infrastructure, whatever it is, boosting the economy, trying not to go into a recession. There's different reasons. And then on the investor side, usually trying to preserve wealth, but when it's up to 9%, you're essentially gaining money anyway. Of course, if you look at inflation, is up to 8%, then it's still preserving wealth. You're not doing much more than that. So the usual rate of bonds, it's much lower. So historically, and I'm going to try to pull up a chart now maybe. So historically, when we look at bonds, we see like 0.5%, half a percentage in yields. Yields is how much your bond is going to give you every year. Well, recently, because of interest rate hikes, which means that the Fed or the Bank of England or the Bank of Europe, Bank of Japan, they've been rising interest rates, which means that the central banks will give high interest if the money are kept within the central bank. That also increased the interest that bonds give. Makes sense, because the same way a bank like, let's say, Barclays, or let's say JP Morgan, can give money to the US government for treasuries, you can do the same by buying a bond as a investor on the primary or second market for bonds. So because of that, rates have been going up, and we've seen bonds yields going up as well. And bond prices are inverted to yields. So what we usually see is that as rate hike goes up, the yield will go up and the price will come down. And as rate hikes come down, the yields will come down and the price will go up. So it makes sense if you think about it as a later point in time perspective, right? If you want to buy a bond, let's say next year, when interest rates are really low, well, it makes sense that you're going to have to spend more money to get that bond that gives you that high yield that got issued when interest rates were high. So of course the price is going to be higher, and vice versa. So that's kind of like how we look at pricing in this sort of situation, and the rates. And there is an inverse relationship that you have to keep in mind in between interest rates and the price of a bond, so yield and the price of a bond. Well, it's not the yield of the bond, it's what the bond will give you on paper. Let's call it on paper, or when it got issued at the standard price. So a 3.5% coupon, it's a 3.5% yield of that bond. So let's say that that bond is a 3.5% for 2 years. So we got different years, different maturity timings. So let's say you got a 2 years bond, and that's a 3.5 bond or 4% bond. It doesn't necessarily mean that your yield is going to be 3.5. So what usually happens is that there will be a pricing mechanism that I'm not going to go into the details now, but we can do a separate discussion. But there is a pricing mechanism that will then define what the price is. So let's say that your bond starts at $100 and it has a coupon of 3.5. So that means that if you keep your bond in 1 year, you're going to get $3.50 for every $100 invested. And that's it. That's your yield, that's the coupon. Now, in reality, it's not always the case. So what happens is as interest rates get hiked and increase, and as prices of bonds come down, what you will see is that if the price of the bond comes down, you're still buying a 3.5 bond with that $100 mark. But the price of the bond and the price at which the bond goes issues in the primary market and secondary market could be 99, 98. Let's make the absurd case for simplicity that the price of the bond is 50, so half of what it was. In that case, you have a coupon of 3.5, but your yield, it's 7%. It's twice as much because you paid half the price, which means you have twice the amount of bonds. So essentially your yield on that bond, it's 7% and not 3.5%. So that's the difference in between the yield and the coupon. And another interesting fact in terms of keywords is you got to look at maturity and duration. So the duration of a bond, it's how long you have to wait until you get a cash flow. So, if I buy and usually it's either yearly or twice a year, or if you buy in a 3 months bond, it will be every 3 months. So that's how often you receive a payment from your bond. And if it's a corporate bond, it's how often the company pays you. If it's a government bond or a treasury, it's how often the government pays you. And on the other end, you got maturity. Maturity is essentially when the contract in between you and the government, you, the company, expires. So when that bond is no longer valid. And that usually is at the end of the maturity period, which is 2.5 years, 4 years, 30 years. So if you look at bonds online, you will see 2 years, 4 years, 10 years. Maybe Francesco can tell a little bit more about the yield curve and difference in between 2 years versus 10 years. We can talk about it in a moment. But that's the difference in between maturity and duration. And then something interesting that I discovered is that let's say you do want to now buy a bond because you think it's really good. You're getting your solid 4.5%, whatever we're getting now. I think in the UK is about 4% now. And you're convinced it's a good way to store your money, make sure they don't lose further value if inflation keeps going up. In this case, it probably wouldn't help, but it helps a little bit. The same inflation come down to 3%, and you're keeping value of your money. Then in that case, let's say you want to buy the bond. So unless you buy the bond from the primary market directly from Treasury, directly from the company, on the day it gets issued, then you have to buy in the secondary market. And what happens in secondary markets is that somebody else is selling it to you. And when they sell it to you, you're not going to buy it at the price at which it got issued. So let's say for simplicity, it gets issued $100 and it gives you 3.5 on the coupon, so 3.5% is your yield. Buy in a secondary market. If I buy from Francesco and I buy, once again, let's say what is a 1 year duration bond, and so it pays me every year 3.5%. If I buy from Francesco 6 months after it got issued, I need to give him 1.75% out of my pocket so that he can get paid for that yield that he would have potentially gotten from that bond. So that's called accrued interest. So he earned some interest. He didn't get paid for it because I'm buying it from him before the first payment, and therefore I need to pay for it. So let's say I'm buying, again, one bond for $100, 3.5%. I'm going to have to give him $1.75. And then I'm going to get the bond. And then at the end of the year, I'm going to get my $3. The $1.75 I get to Francesco and my $1.75 that I got from buying the bond. So effectively, I'm getting 6 months of interest. And it's called accrued interest. And the sum of the price, so the total price of my bond is called dirty price. The dirty price is essentially the accrued interest plus the price of the bond on the market. plus whatever fees you usually have. So in this case, the dirty price wouldn't be $100, it would be $101.75. So that's the actual price at which you would buy the bond.